Thank you all so much for being here. This is the third episode of the series for the ins and outs of real estate investing. The purpose of this webinar is really to give you the tools and resources that you need to invest in real estate, to understand the investors that you work with and speak their language, as well as if it's something that you want to invest in, to follow those dreams and strive for more financial security and cash flow. So today's topic is the facts and figures, the numbers behind the deal. So I'm going to keep it as simple as possible today, not because you aren't all super intelligent and can, understand the math, but just because really it doesn't need to be too complicated. And a lot of the time it gets really complicated when you start to, use some terms that higher level investors use for really large deals, but it doesn't need to be that difficult. So today's topic is the facts and figures. There will be two more sessions. The next two sessions will be people matter. Who do you need to have on your team? Of course, real estate agents are on that list of who you need to have on your team, as well as many others. And then the final one, the fifth session in 2 weeks, will be next steps and your action plan. So today, this class, I'm going to go into, it's going to kind of go something like this. So first we're going to review the last two webinars that I did super briefly. I'm going to run through the advantages of investing in real estate, identifying the right property, and then we'll cover the numbers. So today's session is super important because when you're investing in real estate, it's all about the financial side, right? There's no emotions involved in this type of investing. And if the numbers don't work, then you don't do the deal. It's as simple as that. So I'm going to run through the review real quick. So the first way that you make money in real estate is cash flow. Rental income minus expenses minus any mortgage payments is your cash flow. We're going to discuss that in detail today. The goal is always to get positive cash flow, of course. And the second way that you make money in real estate is leverage. So you use debt and other people's money to buy real estate. You can get a loan to pay for some of the property instead of paying for all of it. The third way is debt pay down and building your assets faster. So your tenants, as they pay you rent, they pay you down your mortgage, and your principal balance decreases every time you pay your mortgage. So effectively, every time that happens, you're decreasing your debt and you're increasing the equity available that you have in that property, therefore increasing your assets faster. So the fourth way is real estate is a natural inflation hedge. And what that means is the dollar decreases in value each year around 2 to 3% on average, and that's called inflation. And when you invest in real estate, not only does your asset appreciate on average 3% over 30 years throughout the country, you can also increase rental payments and rental income depending on where you are. Some people increase it 1% a year, 2%, even 3%. And in some states and areas, you can increase the rent as much as you want, whenever you want, and there's no laws against that. So as the dollar decreases in value, your property increases in value, and you can also increase your rental payments that people pay you. So therefore, it's a hedge against inflation. It's like betting against inflation, right? Betting against the dollar. The fifth way is tax advantages. So you have multiple tax advantages in real estate. You can write off the interest on your mortgages. You write off depreciation, which is 27.5 years for residential properties and 39 years for commercial properties. So the government allows you to write off that certain amount, that percentage value of the property that you paid over 27.5 years. So if your property is $100,000 you would divide that by 27.5 and deduct that as an expense on your income statement each year to write off on your taxes, so that you don't pay taxes on that portion of your income. The other ways are 1031 exchange, like-kind exchange. You can defer your capital gains when you sell properties. You can also put your properties in trusts when you give them to your relatives, therefore not having to pay taxes on a certain percentage or up to a certain amount of that transfer when you give it to a relative. There are no early withdrawal fees for your money like there are in retirement accounts. So that's really important to just remember. You can sell a property whenever you want without taking a withdrawal fee, such as in a 401k. There are also no penalties for insider trading. So that's great for real estate agents. So the next thing that we're going to cover is just reviewing identifying the right property. So the first part of that we went over last week was thinking the right thoughts. And many of you probably know my mother, Michelle Daniher, real estate agent in Chatham. It was really funny. Yesterday, she gave me a call. I was out for a hike, and she gave me a call, and she says, Ryan, I was watching this Diana Kokoska video, and she was talking about how she observed an atom under a microscope. And when she did that, and the atom split apart, only 0.001% of that was actually a particle, and the other 99.99% was just energy. And it was such an amazing reminder that energy is everything, and we create our own energy, and it starts with our thoughts. Our thoughts become our actions, which become who we are, our character, and that's how you really reap the fruit of life, and you build your destiny. You create your life based on what you think. So you've got to think the right thoughts. This is definitely a challenge for most people, especially myself. I know, just having the right thoughts at all times, and it's about that rewiring that's super important. So investing in real estate, you want to make sure that you're thinking the right thoughts and asking yourself, how can I do this, rather than saying I can't do something, right? So the second thing is studying the right source, reading the right books, using the right outlets, coming to a class like this and learning a little bit. There are a lot of teachers that are much better than me, so I encourage you to go out and find those people. You want to pick the right plan. There's many different avenues that you can go in real estate. You want to make sure that you pick the plan that's best for your goals and dreams. The next thing is acquiring the right asset, the ones that make money, the ones that fit your plan, whether that's vacation homes, single family, multifamily, commercial properties. You want to pick the right asset for you, because you can make money many different ways in real estate, but everybody does it differently based on what they want. The final thing is managing the right metrics, which we're going to go over today. So managing the right metrics, what to look for, the numbers to look for, the calculations, and what metrics you're going to use when you're analyzing a rental property. So another thing that we went over is just how important economies of scale are in real estate. So with, for example, a multifamily property between 2 and 20 units, you have one roof. You can sub-meter utilities so that everybody pays their own utilities, and you can do more deals in less time. Rather than buying 20 properties, you could get 20 units under one roof and have great economies of scale. So many people think it's more risky and more costly because it's more costly to do a deal that size. But in the reality, it's less risky, because if one unit under a 20-unit property goes vacant, you only have a 5% vacancy. Whereas if you have a single family home and that goes vacant, then you have 100% vacancy. So keep that in mind when you're looking at what your plan is and what type of property it is that you want to buy for your investment portfolio. So, and also always remember, if you find a good deal, the money will find you. There's an abundance of money out there. So many people that want to invest in real estate. The hardest thing is to find the deal. So you find the deal, you're guaranteed to attract and find that money. So let's move on to the numbers behind the deal, what we're here for today. I like to say the numbers don't lie. You can always do the math to the nearest penny. Right? The numbers do not lie. So there are multiple things that I do when I look at a new property, but most importantly, I look at the numbers. If they aren't good, then walk away. Don't spend your time on something and get emotionally attached to something if the basics don't work, if the numbers don't work. So before you do anything else, just run some numbers and make sure that they work. If not, move on. As an investor, the most important thing that I look for is cash flow. Cash flow is super simple. It's income minus expenses. That's it. Sometimes people make running numbers super complicated, but at the end of the day, you want to know what you're getting after expenses each month. What are you taking home? What's coming in? So no need to predict like appreciation or anything like that. There are 4 simple steps to running your rental property numbers. And we're going to go over those right now. They're here in front of us. So the first one is figuring out the monthly income. This is your gross rental income. This will either be what the current tenants are paying at the property that you're looking at and evaluating. It could be the asking rent for the property. If you have neither of those available to you when looking at a property, then give a call to your property manager, who can give you the fair market rent for that property, depending on its location, and the inside and everything. I also use a website sometimes called Rentometer, Rentometer, rentometer.com. It's great. It's free for a certain amount of uses until you have to start paying for it. But basically what's really cool is you just plug in the address, you plug in the property's current rent, the bedrooms, the size, and you put a search radius in, and it gives you all of the comparable rental income and rental properties for that area. It pulls from all the different sites, Zillow, HotPads, Trulia, all that. And then it gives you the median rent, the average rent for a unit like that, and then also gives you all the way from the bottom 0% up to the 75th percentile and even the top rent for that area, which is super cool. Thank you for posting that. I appreciate it. So then one of the first analyses that I do when I look at a rental property is I take the monthly rental income and I divide that by the purchase price of the property. And that's called the price to rent ratio, or the rent to cost ratio. The goal of that is to find out what percentage of the purchase price is 1 month's rent. So what I look for is above 1%. For example, if you have a $1,000 monthly rent and the property costs $100,000, then you have a 1% rent to cost ratio. I know in Chatham, where I live and where I grew up, properties could cost $800,000, $700,000 for 2 units that might only bring in like $5,000 or $6,000. That would be a less than 1% price rent to cost ratio, and we'll go over that super soon. So the next thing that you want to do is you want to calculate your expenses. So this includes property taxes, insurance, property management fees, your mortgage or financing costs, any HOA fees, vacancy, and repair costs. So property taxes. In order to get that, you want to look at your state's Department of Assessment and Taxations. You can find that website by Googling it online. Some municipalities also have that information if you go straight to their accounts. And then what you want to find out is that city, county, and state tax rate. So, in New Jersey, we pay pretty high taxes compared to other parts of the country. I know my property's in Maryland. After city, state, and county taxes, it's only about 1.8 to 2%. So it's a lot less than what we pay up here in New Jersey. So you can find all that information by going to those municipalities' websites, the state website, to find out what the tax rates are. Insurance, you want to make sure to get a quote from a local insurance agent. All properties are going to have a different insurance quote. I usually use 1% of the purchase price as a yearly cost for insurance. And I have a spreadsheet that I'll show you to show all of these different expenses and how I calculate those. And then you have a property management fee. So between 8 to 10% of the monthly rent, usually. And you also need to include in there, sometimes a property management company will charge a fee for placing a new tenant and getting a tenant in the property. They even charge for renewing those lease agreements sometimes. So you want to speak with a property manager, understand exactly what their costs are going to be associated with that. Next, you have your mortgage. So to calculate the monthly payment, you can use an online calculator or Microsoft Excel formulas if you know how to use that. You can basically Google like mortgage payment calculator, or you can Google how to do a mortgage payment calculation on Excel. I enjoy Excel. I use it a lot. And then also, you want to confirm that with your lender to make sure that you're calculating the payment correctly. You also know what the down payment will be, the interest rate, amortization and loan payment schedule, what that will be. That's super important and has to do with what your mortgage payment will be. So talk with your mortgage advisor about that. Then you also have HOA fees, not all the time, but there are properties that people buy as rentals in HOAs. So you want to make sure that you know what that is. The vacancy rate is super important. A lot of people go into a property and say, oh, there will be no vacancy. I won't have any units that, or a property that goes vacant. And let me tell you, last year I have a 3-unit and a 2-unit. The 2-unit was occupied all year, and the 3-unit, I had one unit that was the three unit property. One of those was vacant for 4 months. And that took away like $4,400 of rental income for me, which was a hit. It basically took away all of the profit that I had for that year. So that can be tough. So you want to make sure you budget for that. Usually between 5 to 10% based on the location, the average vacancy in that area, and the property size. So if you talk with a property manager for that area, ask them, hey, what is your average vacancy rate across your portfolio? Or what is your vacancy rate right now? Maybe it's 3%, 7%, 10%. So you want to know that information. And then you have repairs. So this is an estimate. I usually use between 5 and 10% based on how old the property is and when it was last renovated. If it's a turnkey property and it's been renovated recently, maybe 5% would be a good number. But if it's an older property, you might want to put like a 10% repair cost in there per month. And then if you don't use that money, put it into an account like a reserve account that's used for what are called capital expenditures. Capital expenditures are larger costs such as a roof or electrical updates, plumbing, things, the HVAC, stuff like that is a capital expenditure. And it's actually calculated differently on your taxes than a normal like repair cost would be. So I take a percentage of the monthly income, 5 to 10%, and put it into an account that's specifically for those big repairs that do come up over time. So the third thing is to subtract those monthly expenses from the monthly rent. This equals your net operating income. This is your monthly cash flow when you're not using debt, when there's no mortgage on the property. If you don't have a mortgage on the property, then that would be your net operating income. If you do, then that's what you get is the cash flow. And I'll show that calculation in an Excel sheet for everybody. So the final thing is you calculate your returns. So the two numbers that I want to see on any property, I'm going to go down to these formulas and explain them in a minute. So the two numbers that I want to see on any property are the cap rate and the cash on cash return. The cap rate basically compares the return on investment to the purchase price. So the cap rate equation is net operating income divided by the purchase price. So you do not include the mortgage payment in this calculation. The cap rate formula is the return on investment if only cash was used to purchase the property, no debt involved at all. So all investors set their own standards of cap rate. The lower the cap rate, the smaller amount of return and the greater the difference of spread between the net operating income and the purchase price. So in New York City, in Manhattan, your cap rates are like 4%. You'd be lucky to find like a 6% cap rate. In other parts of the country, you might have like a 10% cap rate or a 12% cap rate. I almost bought a property in Texas that had a 15% cap rate. After I did an inspection, I realized why, because it was really, really a crummy apartment building. So the smaller the cap rate, usually the higher the end of property, like really, really nice Class A properties are going to have a lower cap rate, but you get a higher return when the cap rate's higher. Okay, and those are usually your Class C or Class B properties that have the higher cap rate. So I really want to look for like a 6% cap rate at the minimum. If I'm going to show an investor a property, it's going to be like, hey, this is a 6% cap rate, between 6 and 8%. If you find something over 8%, probably pretty good. And you're doing well, in my opinion. And we'll go over that on an Excel sheet. Then you have your cash on cash return. So this is the number, how much basically return you're getting on the money that you invest. If you pay cash for the property, then this number is going to be the same as your cap rate. So cash on cash return is going to be equal to the cap rate if it's just like a cash purchase and there's no debt involved. But what's really cool is the numbers are going to be different once you get debt involved. And that's why debt can be really good to use sometimes, because you can make a higher return on your money. So the equation for the cash on cash return is your net annual cash flow divided by the total cash invested, or cash to close. So very different when you leverage a purchase than when you do an all cash purchase. So here we can see the real value of leveraging and using debt. You can get a greater return on your money than using all cash. And we'll do a calculation there. So you can see the numbers behind the deal right here. So income minus expenses equals net operating income, or your NOI. NOI minus debt service, or mortgage, is your cash flow. The rent to cost ratio equals monthly rental income divided by purchase price. The rent to cost ratio can kind of be used as a weeding out mechanism. So like if it's not above 1%, I'm not going to look at it. If it's over 1%, then I'll take a look at it. And sometimes, if it's a super expensive property, a 0.8 or a 0.9 could make a return, but 1% is kind of like that's what I use as my guideline. And then your cap rate is equal to your net operating income divided by purchase price, and your actual cash on cash return is equal to your cash flow divided by the cost to close, the amount of cash that you put into the deal, closing costs and down payment. So we're going to start by looking at one of these deals. Can you all see the numbers here, or should I maybe go a little bit closer in? Is that better? Okay, good. All right. So this is the first example that we're going to take a look at here. So in this example, the purchase price is $100,000. The loan amount would be $80,000. This is using debt. The down payment would be $20,000, 20%. And for the closing costs, I usually use between 3% and 5% of the loan, but you want to talk with your title company and your lender to take a look at this. So that would be a total cash to close of $22,400. Let's say the monthly rental income for this property was $1,300. This is actually, properties are about that down in Maryland, where I own my two investments. And then in this case scenario, your rent to cost ratio would be 1.3%. So that's monthly rental income divided by purchase price. So the expenses for this property, let's say that the property taxes are about 2% of the purchase price. So that would be a property tax cost of $167 a month. The insurance cost would be $83 a month. You have vacancy of $130 a month, which is 10%, property management at 10%, repairs at 5%, which is $65 a month. And those expenses would be $575 a month. So in this example, your net operating income is $725 per month, or $8,700 per year. Now, with this example, at an $80,000 mortgage, your mortgage payment would be close to $400 and about $4,600 per year. So I know it doesn't look like a lot, receiving cash flow of $343 a month, but imagine if you had 20 of these properties, right? Then you'd be making a pretty significant amount of money each month just off of these rentals. So if you have $4,116 of cash flow per year for this property, and your total cash to close was $22,400, you're going to have an 18.38% cash on cash return. That's a really good cash on cash return. A lot of guys that I know won't do a property unless it has like more than a 12% cash on cash return. In this scenario, if we take a look at the cap rate down at the bottom, it's 8.7%. That's the net operating income divided by the purchase price. So as we can see, the net operating income is $8,700 and the purchase price is $100,000. So this is assuming that there's no mortgage involved in the purchase of the property and we bought it all cash for $100,000. The cap rate would be 8.7. So can you see how in this example, if you were to use debt and you had a mortgage, you're actually going to have a greater return on your money. So that's why leveraging can be a really useful tool if you use it correctly. So
Ryan?
Yes.
Do you have a standard format for what kind of financing you use when you get a mortgage? Would you ever do a 20-year or 15-year, or do you always go for a 30-year to keep the payments low, or is it self-amortizing even? What's your standard?
That's a really great question, Howard. So for me, I'm always going to look for the longest amortization I can get. For like a commercial property, you'd be lucky if you got 25-year amortization or 20. But for a single family property like this, if I could get a Fannie Freddie loan for 30-year amortization, then, I'm going to go for that because I want to have the cash flow. As long as my tenants are paying down the property, I don't really mind if it takes longer because the cash flow is what I would be investing for in this case scenario. Cool. So we'll take a look at the second example and then we'll of course pause for some questions to run through. So this example, what I did is I increased the purchase price. All of this is like just self-calculating, this Excel sheet that I have. And for anybody that wants it, I can share it with them. I have a number of different models that I use, but this is just for today. So if the purchase price is $500,000 and you were to get a loan at $400,000, 80% loan to value, your down payment is $100,000. And let's just say your closing costs were $12,000. So your cash to close in this scenario would be $112,000 with a mortgage. Let's say your rental income per month was $3,500. It was like a 3-bedroom in Morristown. That was pretty nice. Your rent to cost ratio in this case scenario would be 0.70%. It's your monthly rental income divided by the purchase price. So your expenses here, immediately, like right away, we should see, oh, well, there might be a problem with this. The rent to cost ratio is less than 1%. Then you've got your property taxes, let's just say 2%. So $833. Your insurance is maybe $416 per month, about 1% of the purchase price value of the property. Property management, 10%, $350. No HOA. Vacancy, you want to make sure you have that in there. So it's 10%, $350 per month vacancy allowance. And then repairs, 5%, $175 allowance there for repairs. So your total expenses would be $2,125. And in this case scenario, that would leave a net operating income of $1,375 or $16,500 per year. So for a $400,000 loan at a 4% interest rate, by the way, both of these loans for these properties that I calculated are a 4% interest rate, and I believe I used a 30-year amortization, or I might have used a 25-year amortization. So the mortgage payment, $1,910. Your cash flow in this scenario would be negative. You would be losing $535 a month and $6,415 a year. So your cash flow, your cash on cash return, which is your cash flow divided by cash to close, would be about negative 6%. So in this case scenario, what's really interesting is if you just use cash and you don't use a mortgage, you would have a 3.3% cap rate. So your net operating income divided by your purchase price would be 3.3%. So if you use debt in this example, you're going to lose money every month. But if you don't and you just use cash, you make a 3.3% return. Now you've got to ask yourself, is that worth it? Is it really worth an investment of $112,000 to make 3.3% on your money? For me, that I wouldn't look at this deal. I wouldn't touch it. But for some people, maybe that is okay. Maybe it's in maybe it's in a really nice area of Washington, D.C., and they think that there will be a really high amount of, appreciation in the future. So some people will invest in a deal like this. It's really just what you're looking for as an investor. So that's kind of everything that I have to show for these two examples. But I will pause for anybody, if anybody has any questions about either of these two examples. So if not, I got some questions. So for anybody that wants to answer, what's the difference between cap rate and cash on cash return? I guess everybody started drinking margaritas already, huh? So the difference between cap rate.
About it.
The
cap rate, the cash on cash, it takes into consideration the closing costs, the money that you put into it. But the cap rate takes it doesn't include the mortgage.
Right. Yes. So the cash on cash return includes deducting the mortgage payments from the net operating income. So, and the cap rate doesn't use debt. It's a cash, specifically if only cash were to be used to purchase the property. That's right. So the second question, why is rent to cost ratio important?
It's going to determine your return on investment.
Yeah. So it's an easy screen technique. It's something that you can do right away without even calculating the expenses on the property and get an idea of will the property cash flow or not. So when would cap rate be useful to use? In what scenario?
If you're buying all cash.
There you go. It's also great to use as a appraisal mechanism. So if you increase the income of your property, because over time the rents go up, and then you decrease the expenses on your property, you can increase the value. There's an inverse relationship there. So the greater the spread between income and expenses, the higher net operating income and the greater the value of the property. Something that I didn't put in here is, I guess you can tell when you do the net operating income divided by the purchase price, that's also how you evaluate the value of a property, right? Because if you multiply the net operating income, or if you divide the net operating income by the cap rate, you get the value of the property. So you can also understand the value of your property just based on the inverse relationship of cap rate and net operating income. So we hear this a lot, or we have before, cash is king. But is cash king or is cash flow king? Because as we saw, even if you used all cash in that first example, you'd make a higher return on your investment if you looked at cash flow, right? If you use debt to your advantage. So talk to your mortgage lenders. So, we really went over this, but what's the difference between the two properties? The major difference is just the fact that one costs more and the rental income is low. It's not high enough to support all of the expenses. And its rent to cost ratio is 0.7, whereas the rent to cost ratio in the first example is 1.3. So that's really all that I have for you all today. I appreciate you showing up, and you can always reach out to me. I'd love to be friends with all of you on Facebook. And for the people that asked to get a copy of the spreadsheet, I can go ahead and send that over to you as well.
Thank you, Ryan.
Thank you, Ryan.
Thanks,
Ryan, that was
Ryan.
awesome.
Thanks,
you very
Ryan.
much.
Thank you. My pleasure. So if you want that spreadsheet, let me just write down all your emails.
I'll send you a list of all of the registrants, Ryan.
Oh,
We
cool.
can send it
That'd
to
be great.
everybody.
Sweet. Thank you.
No problem.
Thank you, Jackie.
Ryan, I have a question. What happens when the closing cost is rolled into the mortgage?
That's a good question. So in that case scenario, the loan amount would increase and the cash to close would decrease. So if you look at this example, the closing cost would be added to the loan amount to $82,400, and the cash to close would go down to $20,000, and you would most likely, definitely actually have an increase on the cash on cash return. So if you can roll in the closing cost to the loan amount and still support the property, I would definitely take a look at that. It should increase the cash on cash return.
Awesome, thanks.
Mm-hmm.
Thank you.
For sure. Thank you all so much. What books would be a good closing gift for the first-time investor? That's a great question. How do you say your name, Evgenia?
You can say Eve.
Eve.
Hi, Ryan.
Hey.
Eve.
Okay, cool. Eve. So I love Bigger Pockets. Bigger Pockets books are great, all of them. Also, Rich Dad, Poor Dad, if they haven't read Rich Dad, Poor Dad by Robert Kiyosaki. But Bigger Pocket and all of Robert Kiyosaki's Rich Dad series are great, but I would stick with some like Bigger Pockets beginner books.
Rich Dad, Poor Dad, I did see that there is one kind of newer book on investing in real estate, kind of, I don't know, distantly, like on something that's not the traditional investment, but I didn't get the name of this book.
That book is called Long Distance Real Estate Investing.
Oh.
Mm-hmm. That's kind of what I've done. When I bought my 2 properties in Maryland, I lived there, so I took care of them for a while, and I'm managing them from New Jersey, basically. And like that first example that I showed that had positive cash flow and a great cash on cash return, it's going to be really hard to find something like that in New Jersey. But if you partner yourself with the right people, which we'll talk about next week, you can really find those types of deals in other parts of the country.
Oh gosh, can I borrow your brain?
You can give me a call whenever you'd like, and just reach out.
Sure, because I was in a.
What'd you say?
I was on a call with the client, and I missed first half an hour with you. So it's also a great educational tool for me when people are reaching out and saying, we want to invest. I'm like, oh my God, I know nothing about it, but I'm ready to learn. So it's also the question for me, what are the good books to refer to? For example, I know that KW has books that are called Hold and Flip, but I didn't order them yet. And I'm thinking, how good are they for people who already, we're closing next week. They already read certain books before they decided that they want to invest. And we're lucky to have a good property. hopefully.
So Hold is kind of like a beginner's book for sure. And I commend you for wanting to educate yourself to better help and serve your investors, because that's like why I'm really doing this whole course. Is so many real estate agents can't speak the same language as their investors. And in order to create a long-term relationship with your investors, you want to know these things so you can talk intelligently about the investments. So for more advanced investors, the Rich Dad Advisors series, Robert Kiyosaki, his accountant, his lawyer, all of those people that he works with, his team, they all wrote a series called the Rich Dad Advisor series. So that's a great collection of books to look at for the more advanced investor that you might want to give a closing gift to.
Okay, so Hold is a beginner's book.
Mm-hmm.
And the Gary Keller's book is kind of, does it lay out, like, is it a good foundation, or I'd better start somewhere else?
Yes. The Millionaire Real Estate Investor is, from what I've heard, is a really good foundation. Believe it or not, I actually haven't read that whole book yet, but I do plan on reading that book this year.
Okay, and Bigger Pockets books, I know that there is a Bigger Pockets website. They have their own books.
Yeah, they do. Yeah, they have a number of books. So the Long Distance Real Estate Investing book, that is a Bigger Pockets book. And if you go on their website, they have a store and they have all their books. I have a number of their books on PDF files and stuff like that. They're great. That's really where like I started. I read Rich Dad Poor Dad like 5 years ago, and then just was on Bigger Pockets. And a number of my clients actually I met on Bigger Pockets. So if you can network with people on Bigger Pockets, you'll find a lot of investors as well.
Ah, okay, cool. Thank you so much.
What'd you say?
I'm already on Bigger Pockets website, and since I haven't read Hold and the real estate, Millionaire Real Estate Investor, I was contemplating whether I should order these ones for myself and for my clients, or go to some other books. So it was like, oh, I don't have time to read all of them. So which ones are the best? Like, which ones can be considered as a good gift, so that they will come back to me in a year.
Yeah, definitely. And I mean, giving books, that's a great closing gift because it's something they're going to have for a long time. I'm not saying like a bottle of wine isn't bad, but a bottle of wine gets consumed and then it's gone. So, books are a great closing gift. Also, Cutco is a great closing gift as well. If anybody here gives Cutco, that's a good one. Maybe not for an investor, but
that's the thing. What do you give to investor?
Right.
That's going to be my first transaction with investor. And somebody says, oh, write the lease agreements for them. I'm like, what? Will that will be the closing gift? So I don't know what will be a good closing gift, but I want them to be happy with me.
I think books are a great one for sure.
What else? What else would you add to the closing gift? Investor.
Yeah, it's a good question. I mean, I think depending on the size of the property, like a couple books would probably be good. I don't know what else you would give, except for if they have a business, get something engraved with their business logo.
Not yet.
Not yet. It's just personally. So I listened to this guy one time. His name is John Rulin, and he has a book called Giftology. He built a whole company around the best gifts to give to people. And what he found is Giftology, Giftolog. The best gifts are the ones that have a person's name, because what's the best sounding word to anybody's ears? It's their own name. So a lot of real estate agents give gifts with their logo on it. So it's like, hey, I'm a Keller Williams agent. Here's my phone number and my logo. I went over to somebody's house one time and I looked at one of their knives. It was a Cutco knife and it had their loan officer's name and phone number on it. And I was like, hey, look, here's your loan officer's name and phone number. And they were like, really? I didn't even know that was on the knife. And they had had it for 10 years. Now, if they have that same knife and it has their personal name on it, they're going to remember. And every single time they see that, it's going to make them happy. And they're going to think of the person that gave it to them. So maybe a signed book, a signed real estate investor book by somebody would be a good idea. Or something that has their name on it.
Wow, that's great.
Yeah.
Great idea, Ryan. Thank you. Now I'll need to think how I can personalize, like, you know, first investor, but not the last investor. So I'll think about it.
Yeah, definitely. It's a good idea.
Wow.
If you need anything, let me know.
Thank you so much.
For sure. All right, y'all. Take care. If you have any other questions, just reach out to me on Facebook. I'll get the list from Jackie and invite everybody.